Welcome to the Drilldown in-depth answers to oil field questions. I'm John Spears.
And I'm Richard Spears.
Hey, Rich, how you doing? So we have a lot of different audiences for the podcast here.
We have short people.
Well, I'm thinking more like what their jobs are.
Oh.
So some who work for equipment and service firms, some who work for operators.
We got the oil companies in there.
We do, but we also
everybody up and down the supply chain.
Right, and investors. And so, and we're beginning to get a lot of questions now because it's August and people are beginning to think about 2021. And so I thought today what we might do is talk about our outlook for in the investment side of things for the oil patch, and so our investor audience group should get out a piece of paper and start writing down notes.
You know what?
Yes,
we should talk to. I mean, we have thousands of people.
Well, yeah.
Today's podcast should be just to a single person.
You're thinking of the Oracle of Omaha.
Warren Buffett.
Warren Buffett. Yeah, he needs our investment advice.
Well, he does because he's he's in trains and planes and automobiles. Okay, so today's podcast is not. A couple of weeks ago we dedicated it to Kathy Lee Gifford.
Oh yeah,
but today's is targeted to Warren Buffett
and the investor community. So the notion being that I think we can think about capital investment going forward as being divided into sort of three phases. As where's the focus of activity going to be, or where it's going to be picking up in terms of activity. So phase one.
I was like things that happen first, things that happen second,
and sort of what drives those, right?
Yep.
So first phase, and rig count stopped falling 2 weeks ago now, went down a little bit last Friday. So, but we're getting to the point now where you're beginning to think about things leveling off, not just going down and down, and beginning maybe to pick up. So where are things going to pick up first? And here's where I think that we see operators, beginning to increase activity initially is sort of cleaning up all the work in progress that got stopped when everybody pulled the ripcord back in March and April, and rig count went down in a hurry. So that left a lot of wells drilled but uncompleted, and I think that's where we're going to see operators first get busy when it comes to sort of cleaning up all that work that just got stopped.
And the point being here that if you've contracted a drilling rig, you've prepared the site, you've moved the drilling rig on location, you spudded well number 1, you spudded well number 2, you got 4 or 5 wells you're going to spud and drill all the way to TD. If the economic incentive of drilling those wells disappears in the process of drilling those 4 or 5 wells, you're not going to stop drilling the wells.
Sure. Right.
You're going to spend another month or 2 finishing the drilling of those wells. But meanwhile, the wells you drilled a month ago or 3 months ago or 4 months ago that you haven't yet fracked, you did put the pause button on those.
Oh, yeah,
Don't do anything.
Right. And again, you hadn't fracked those wells because you were probably waiting on a gathering system to be put in place or production facilities. And so normally you see 2-3 months go by between the time you frack a well, drill a well and when you frack it. So
80 days.
Right. And again, we were running 800 or more rigs, and so we had several hundred wells that were normally going to be completed, and all of a sudden we dropped to below 300 rigs running. So there's just an awful lot of wells that are in this drilled but uncompleted category, and I think those are the ones operators are going to focus on to get them completed and hook them up and put them in production.
This is specific to the United States.
Specific to the United States, absolutely right. So that phase I think is now beginning, but the amount of work to be done and the number of dollars to chase that work suggests to me that this is not just something that's going to be finished in a quarter. This is probably 4, 5, 6 quarters of activity in this cleanup phase of operation.
Okay, so let me think. We're here in the third quarter of 2020.
Yes.
That puts you into the third quarter of 2021.
Easily,
while we're still doing the cleanup part.
Yeah, that has nothing to do with where rig count's going. This is a whole separate deal because we're just handling the work that got stopped.
So this has a life of its own.
Yes.
It has a metric of its own.
Right.
And so if it's going to be completion related work, then it's also going to be here's a new well that's being commissioned.
Right.
It'll be the artificial lift part too.
Yes,
it'll be the installation of flow lines, gathering systems.
So you think about, again, our investor audience. Who would we, what are the firms or what are the segments that are going to benefit from this kind of this
Warren,
phase
here
one
you
thing?
go. Liberty, next here, Halliburton.
So these are all frac service firms.
And then there's going to be the coiled tubing companies and workover rig companies that have the great big units
that you need to handle those kind of.
because you're going to be drilling out frac plugs that are 25,000 feet away from the surface.
Oh, yeah, right. So you've got
to have big units.
Yeah, gotcha.
All right, so those are the winners.
So that's sort of phase one, I think, as we see it. Beyond that, then there's all, the industry will require oil prices and commodity prices, oil and gas prices, to begin to recover, so that there's cash in the hands of operators in order to go about drilling new wells and bringing on new forms of production.
Do you have an oil price?
When we talk to the folks that we know in the field, a lot of them are telling us that it's still a $50 plus oil price world before those kind of monies begin to get turned back on.
All right, so here's my question. So it's $50 at today's service cost level, and there's heavy discounting going on right now.
Yeah.
And so as a result, as utilization of those things, drilling rigs, pump trucks rises, and the price of those things will rise. So is $50 at today's service price?
Yeah, I think it is. Because we'd heard about $50 being the sort of the magic number in years past as well. But I think the industry's emphasis on improving profitability means that you've still got to take that $50 price combined with today's lower cost of services, reflecting that discount that's being provided.
So it's not a static number. It's not like for all time it's $50, because it'll rise to 60, and then it'll rise to
there'll be
70.
Some cost push inflation for sure in this. But I think once we began to see oil prices move above $50, then I think we can begin to see a second phase of investment picking up. And that's where, again, rig activity is going to pick up. So we're back to drilling wells and then all the associated completion of those wells and so forth. So we're just starting from a rig count that's below 300.
So Warren, if you're in the part two of this, in the second phase of this recovery, it's going to be the drilling contractors and the drill bit companies and the directional drilling service companies and the drilling fluids companies, anything that has the word drilling associated with it.
And so if we think that kind of activity begins to pick up in 2022, let's say that's
a long time from now.
Yeah, right. But as an investor, when do you put your money to work, right?
6 to 12 months in advance of the pickup, right?
Well, traditionally that would be the case, right? The market's wants to move before activity takes off.
So really, by around Halloween or Thanksgiving of this year, you get your bet in place.
Well, that's one way to look at it. That's for sure.
Warren, you're on your own about the timing, but we told you where.
But it is something to think about. But I do think that second phase, that price-driven recovery investment phase, is something that's probably going to happen more like 2022. Now, the third phase is a longer ways down the road, but that is, I think, then associated with this issue of what is the utilization of the assets of the oil service industry. Because there's a certain number of firms, publicly traded firms, whose basic business is in the construction of the fabrication of assets that the service industry needs in order to get its work done, right?
Big manufacturers of equipment are, of course, National Oil, Varco. Then you've got Forum. They're a significant manufacturer. Gardner, Denver, Weir.
So again, this is rolling stock that the service company uses to drill wells and complete wells and so forth. And that business is traditionally been one where the service companies need to enjoy both good profitability and high utilization of their existing fleet. And then they begin to think about either expanding the fleet or replacing older obsolete units. And so that phase of business really depends upon what's the utilization of my equipment. So
that is not a 2020 or a 2021 or a 2022.
I don't think so. I think so. I mean, clearly the industry has a lot of incentive to consolidate and rationalize that asset base. And that is going on and will continue to go on. But boy, getting to the point where, because traditionally you need to see something close to 90% utilization before we began to see the dollars spent to add to the fleet of equipment out there.
This probably applies to not just land, but also offshore.
Yeah.
Because offshore,
right.
It is not immune to this cycle, and you've seen activity cycle down quite a bit.
Yeah. Now, it may not be quite as drastic as we're painting the picture, because again, we're thinking North America. And North America would be a long time for
it's
the assets.
It's outside our door.
Yeah, right. If, on the other hand, you're thinking about equipment that gets used globally and what's demand for that equipment, the international picture is going to be a little bit better, because while activity's fallen 75% here in the U.S., it's down 25% internationally. So
So it only needs to rise a few tens.
Right. A few quarters before now you're back to that point. So that is a wrinkle that we all need to be aware of. But that last group, that asset utilization phase of the business, is a ways off yet, as best we can tell.
This is why when you think about all the couple hundred publicly traded service companies, and then the thousands of privately owned companies, you have to look at a company like Schlumberger and say, I know they're the biggest, I know everybody invests in those guys, but they're in this first phase, they're in the second phase, they're in the third phase, they're in each of these phases, and so they would benefit along the way.
Yeah, absolutely. So you have to give everything good consideration. I mean, you have to pay attention to how everything's shaping up, and but I think that's the way I think it's useful to think about how the stages of this industry recovery take place and unfold, and roughly the timing of it is. And if Warren wants to have a private conversation, then he's certainly welcome to call us up, and we'll answer that phone call.
SpearsResearch.com. We can be found. Come on, Warren. I'll drive up to Omaha to come see you.
Well, anyway, thanks so much for listening to The Drill Down. This has been John Spears.
And I'm still Richard Spears.